It was another wild week in the financial markets with interest rates fortunately backing away from their highest levels in decades. Let's discuss what happened and look at the things to watch for the coming week. The jolts and jobs report do indeed jolt the markets. On Tuesday, the jolts report, which shows how many jobs are available, ticked up much higher than expectations. As a result, a knee-jerk reaction caused interest rates to spike to the highest levels in 16 years on fear that the labor market remains too tight, and the Fed will have to continue to hike rates and hold them higher for even longer. The market reaction seemed overdone as a look into the details showed that the number of people quitting and the number of people hiring continued to slow, suggesting that the labor market is cooling down to the Fed's liking. The BLS jobs report for the month of September, released Friday morning, did not help much either. The headline number was 336,000 jobs created, nearly doubling expectations, with the unemployment rate holding steady at 3.8%. Bonds sold off initially with the 10-year Treasury jumping to 4.86%, the highest level since July of 2007. Yields settled out a bit lower by the close at 4.79% after it was noted in the report that wage inflation is softening. If the Federal Reserve can stamp out wage inflation without destroying jobs, that would be a goldilocks scenario and could further support the possibility for an economic soft landing. The Fed is still talking tough, despite recent weaker economic data as of late and the run rate of inflation headed towards the Fed's target zone. Federal Reserve officials continue to talk about the need for more rate hikes and the idea of holding them higher for longer. With mortgage rates at multi-decade highs in response to rising Treasury yields, we are seeing a sharp slowdown in housing activity. But don't say that to Atlanta Fed President Raphael Bostic, who uttered this gem this last week. He said rising long bond yields have not had an excessive impact on the economy. Yeah, right. The financial markets are not buying all the tough Fed talk, as the Fed funds futures market is currently pricing in no more rate hikes. Dealing with debt and deficit spending, interest rates have ticked higher throughout this past summer as the U.S. Treasury Department demanded more money than previously expected to fund our government. This action led to a downgrade of our debt by Fitch rating agency, citing fiscal deterioration. It's not truly clear if interest rates are pricing in all this deficit spending or if rates will go higher still as our federal government requests more money to fund its operations. Bottom line, bad economic news will continue to be good news for interest rates and the market. On the other hand, our excessive debt is applying upward pressure on rates. With the Fed still talking tough and the trend of higher rates still intact, there's a lot to watch. Now, looking ahead, this coming week carries a bunch of headline risks with the Consumer Price Index, or CPI, inflation reading, as well as the Producer Price Index and consumer sentiment. Another potential market catalyst will be another boatload of Treasury supply coming to auction. Will buyers demand more yield or higher rates to purchase these bonds? We shall see. I appreciate you taking some time and joining me here today. Be sure to like and share, comment, and have a great week.